But then there's the Fed, John and Liz Ann. We are also watching the Fed meeting this week. Now, we're going to hear from the Fed tomorrow. No change in policy is expected from this meeting. But Allianz Chief Economic Advisor Mohamed El-Arian had something interesting to say yesterday about the Fed. He basically said they are going to say something about a rate hike. They're going to suggest that it's not happening soon, and they're going to push it from September to December. Listen to what he said, Liz Ann. I got to get your take.
I'm not sure they're going to hike in September. In fact, we have a Fed meeting this week, and we're going to hear three things from them on Wednesday. One, they're going to become more cautious about the economy, especially about inflation. Inflation is a worry for them. It's not high enough. Two, they're going to suggest that we still get a rate hike this year, but they're going to push it back more to December. And three, they're going to explain to us that their balance sheet reduction is going to be like watching paint dry. They're going to tell markets, don't get excited. There's nothing here that you should worry about.
And we know it's a $4.5 trillion balance sheet, Liz Ann. Are you worried about as they begin to wind down this balance sheet? And do you agree with what he just said?
Well, you know, it is always heartening to be in agreement with somebody as brilliant as Mohamed. So, yes, I do think that we might get a little bit further color on the balance sheet reduction at the July meeting, but I agree we're not going to get any policy changes. And it is our view that the balance sheet reduction will begin in September. And it's always been our view that at the start point of that, they would not also throw a rate hike into the mix. So I agree that the most likely scenario at this point is balance sheet reduction begins in September and another rate hike possibly comes in December, which, of course, would be data dependent. Now, I have no idea whether this is going to be a tumultuous exit from a $4.5 trillion balance sheet because we are in uncharted territory. However, you have to look back and see that a lot of periods of market volatility have come because of missteps or perceived missteps on the part of monetary policy authorities. So I think to assume we're going to get a perfectly benign series of actions here by the Fed as they start to move further toward policy normalization, I would expect to see some bouts of volatility around that, given that we've never done this before.
Liz, you mentioned a moment ago this idea of a dangerous melt-up scenario where asset prices keep rising and rising and become unsustainable. Well, we had a dangerous melt-up in the 2004 to 2006 period in real estate asset prices, and that was a period when the Fed was very predictably, very cautiously raising interest rates in little bits every few months. We have a Fed right now which is very predictably, very cautiously raising interest rates every few months, even more slowly than then. Isn't that a potential ingredient for the kind of dangerous melt-up in asset prices that you were just talking about?
Possibly, except that since the Fed has been raising interest rates, financial conditions have actually loosened. And that, to me, is the good background.
That's what I'm saying.
So as long as financial conditions, I think, remain fairly loose, I think that gives the Fed some runway to continue to raise interest rates. Once they get a bit too tight, then I think it's a problem. I agree that this is an issue. When you look at the last two kind of bubbles that inflated, tech stocks obviously in the 1990s and then purely real estate, now there's this view that maybe we have an everything bubble because if you look at household net worth and the components thereof, kind of everything is on a high. But when I compare valuation metrics, either to specific sectors or more broadly to where we were back in those eras, I'm not quite sure we're there yet. I think it's something that... Go ahead.
Is the Fed setting the stage for a bubble by staying loose for so long at this point and by moving so slowly towards tighter policy?
Well, one could argue based on the inflation data, some are arguing that they shouldn't be doing anything here. I think the Fed is continuing to maybe plow ahead is a little bit too strong a word given how slow they are relative to your point, the 2004-2006 cycle where it was 17 consecutive meetings, 17 consecutive 25 basis point increases. But I think they are in moving kind of against what their inflation targets are suggesting is appropriate.
Yeah.
Tells you that they are somewhat mindful of this asset price issue, and that's why they want to continue to move ahead.
Well, I mean, there's the inflation issue, but then there's also the economic growth issue, right, Liz Ann? I mean, look at tax receipts, look at the growth of 1.5%. We're expecting a GDP of 2.1%. But it's a fair question to ask is, does the Federal Reserve smash an economic recovery that's just gaining traction with this interest rate hike string?
Well, I hope not. Remember, you know, expansions end and recessions begin because of excess, and it's often excess monetary policy, a Fed that's moved too far too fast or combating an inflation problem. That tends to be one of the excesses, capital spending excess, capacity utilization excess. If there's one benefit to this entire recovery having been sluggish, this 2% secular stagnation, new normal, whatever term you want to apply to it,
right,
is that we haven't built much of those excesses. And expansions don't tend to simply die of old age. They die because of excess. They die because of that excess monetary policy typically. And I just don't think we're there yet. I think the Fed, again, still has a decent runway to move here. But again, I do think we're going to get some choppiness in the market here. And, you know, 5% pullback in the market, I think, would be extremely healthy.
All right. We will leave it there. Liz Ann, always a pleasure. Thanks so much.
Thanks, Maria.
Liz Ann Sonders, Charles Schwab there.